Let me now turn to our distinguished guest speaker. Dr. Lane became Deputy Governor of the Bank of Canada in 2009, and in that capacity he has overseen the bank's overall international economic work. He has also shared responsibility for setting monetary policy in Canada and has been heavily engaged on the international scene as G20 deputy for the Bank of Canada. Prior to that, Dr. Lane served at the IMF for about 20 years, and he led significant work on a number of policy and research issues at the IMF, and I had actually the pleasure of meeting Dr. Lane for the first time when we were both at the IMF. So, Tim, I'm especially delighted to welcome you to CG, and we now turn over to you for your address on Follow the Money, a Canadian perspective on globalization. And after your remarks, my colleague, CG Senior Fellow Pierre Siglos, will moderate the Q&A. So, Tim, over to you. Thank you very much.
Okay, well, yeah, thank you very much, Domenico, for that kind introduction. And as you mentioned, I mean, I've had the privilege of interacting with you over the last several years on a number of these global issues. I certainly appreciate the opportunity to speak to the CG audience today, we certainly note that the movement of goods, services, people, and money across national borders has been, I guess, has always been controversial, but I think never more so than the present time. I mean, it seems to be becoming more hotly debated by the day. Now, in this context, of course, it's particularly important for Canada to be engaged fully in the global policy dialogue. And as a medium-sized country, we can really only do that if we can actually bring to the table new ideas and superior analysis. And that's really where CG's contribution, I think, is particularly vital. So today I'd like to focus on one specific aspect of globalization, which is international capital mobility. And in my remarks, I'd like to start by opening up some basic questions about capital mobility, and then I'll go on to review some of the key trends in capital flows that have been going on over the past few decades. I'll then go on to discuss the benefits and challenges of being open to capital flows and the policy tools that are being deployed by some countries to manage those flows. And finally, I'm going to take a bit of a Canadian view and take you through some of the main aspects of Canada's experience in this regard and the factors that have enabled Canada to conduct an independent and effective monetary policy in the face of free capital mobility. Now, in looking at this area, I think one thing that's striking is just how different the perceptions of capital movements across different countries are. And I mean, of course, in Canada, we actually take our ability to move funds across our borders mostly for granted. Canadian investors hold U.S. equities, for example. Snowbirds open U.S. bank accounts and they run up bills on U.S. credit cards. Canadian companies borrow and issue shares in U.S. equity markets. Also our governments, of course, sell bonds to foreign central banks and to a whole range of other foreign investors. And transactions in this sort of category actually constitute the vast bulk of the capital that's flowing across our borders. And most of us, I'd have to say, don't really give them a second thought. Now, if we look at the bigger picture, capital flows in and out of Canada in response to broader economic trends. À l'heure actuelle, le Canada traverse une période d'ajustement complexe au bas prix de pétrole et d'autres produits de base. Dans ce contexte, le pays dans son ensemble dépense plus que ce qu'il reçoit du reste du monde. Autrement dit, sa balance courante est déficitaire. Les capitaux qui entrent au Canada sous diverses formes financent ce manque à gagner. Ces entrées facilitent les ajustements économiques nécessaires qui ont lieu. So I'll repeat that in English. At the present time, Canada is going through a complex adjustment to lower prices of oil and other commodities. In that context, Canada as a whole is spending more than it earns from the rest of the world. In other words, it's running a current account deficit. Capital is flowing into Canada in various forms to finance that deficit. The inflows are accommodating the needed adjustments that are taking place. The experience of many emerging market and developing countries, though, have been quite different. Many of these countries have, over the last few decades, experienced the devastation of capital account crises, when sudden stops in foreign capital, often accompanied by capital flight by domestic residents, forces the economy through wrenching adjustments. In such episodes, capital flows take on a life of their own. They become a driver rather than an enabler of economic decisions. They can raise significant concerns for both economic and financial stability. In many of these countries, capital flows are seen as driven mainly by external forces, in particular by the monetary policies of the major advanced economies. In the 8 years since the global financial crisis, ultra-low interest rates and unconventional monetary policies in the United States, the Euro area, and Japan have created incentives to search for yield, which have led to large surges of foreign investment to many emerging market countries. There are concerns that these flows are not sustainable, that when monetary policies in the advanced economies eventually return to normal, the flows could reverse in a disruptive way, particularly for those EMEs whose domestic fundamentals are weaker. We had a hint of that in the taper tantrum of 2013. In the same vein, over the past week, market interest rates and capital flows worldwide have shifted sharply, along with changing perceptions of the direction of economic policies in the United States. Financial globalization raises another question. Can a central bank still conduct an effective monetary policy to fit its own country's circumstances and objectives? International capital mobility has given rise to a global financial cycle through which asset prices, long-term interest rates, and capital flows in many countries tend to move together. But long-term interest rates and asset prices are key transmission channels through which monetary policy affects the national economy. If these channels are compromised, policy could become less effective. In Canada, we've been living with an open capital account for several decades now. But our flexible exchange rate gives us room to conduct an effective monetary policy that's consistent with domestic economic and financial conditions. In many other countries, however, there are legitimate concerns that their monetary policies may be overwhelmed by this global financial cycle. Some have even argued that capital controls could be a precondition for monetary policy independence. En comparant l'expérience du Canada à celle des pays émergents, on pourrait conclure que les flux de capitaux sont un bon serviteur, mais un mauvais maître. L'ouverture aux flux de capitaux mondiaux est avantageuse lorsqu'elle offre aux résidents d'un pays une plus vaste gamme d'occasions d'épargner, d'investir et d'emprunter. Elle est néanmoins nuisible si elle exerce une influence déterminante sur l'économie et empêche le pays de suivre son propre cours. Alors, comment peut-on apprendre à vivre avec les flux de capitaux et à en tirer parti tout en protégeant l'économie de leurs effets sans compromettre l'indépendance de sa politique monétaire? So in contrasting Canadian experience with that of EMEs, we could conclude that capital flows are a good servant but a bad master. Being open to global capital flows is beneficial when it serves residents by creating a wider range of opportunities to save, invest, and borrow. But it is harmful if it becomes a controlling influence on the economy and curtails the country's freedom to chart its own course. So how can a country learn to live with capital flows, to reap the benefits while insulating its economy from their effects and maintaining its policy independence? Let me start by characterizing briefly some recent global trends. For much of the past decade and a half, advanced countries ran current account deficits and received funding from emerging market and developing countries. This seems odd since rapidly growing emerging market economies surely had vast needs for investment, creating opportunities to earn much higher yields than those offered by investments in advanced countries. This counterintuitive flow of funds corresponds to large differences in national savings, of course. In particular, while Chinese households and firms save a lot, those in the US do not. Over the same period, we saw massive expansion in gross flows, a testament to rapidly increasing global financial integration. This process has been anything but smooth. Global gross flows more than tripled in the early 2000s. The flows then fell sharply in 2008-09 during the global financial crisis, recovered somewhat, but remain well below pre-2008 levels. The composition of gross capital flows also shifted considerably over this period. FDI has been the most stable form of capital flows as it tends to be driven by longer-term corporate decisions. Portfolio flows, on the other hand, are easier to liquidate than FDI and thus tend to be more volatile. Other flows, as they're categorized, in particular banking flows, have been most volatile of all. Bank lending, of course, tends to be pro-cyclical, rising in good times and falling in bad. So how does Canada fit in? We have traditionally been a capital importer. Our current account balance has typically been in deficit to the tune of 2 or 3% of GDP. We've depended on external finance to fund this gap. This pattern changed, though, in the early 2000s, when strong foreign demand and high commodity prices raised our national incomes, and we ran current account surpluses for a number of years. These were years during which we exported capital to the rest of the world. Since the global financial crisis, foreign demand has been on a weaker track, and commodity prices, particularly in the last 2 or 3 years, have been significantly lower. Our current account is again in deficit, and once more, we are relying on capital imports from the rest of the world. As I've already mentioned, opening up an economy to capital flows brings both benefits and challenges. The benefits of financial globalization are similar to those of free trade. Open borders create opportunities for transactions that could benefit both parties because of differences in their endowments and/or their preferences. Cross-border investments, which give rise to gross capital flows, also enable investors to diversify their risks. Canada's pension funds, for example, have used international opportunities effectively to provide a more secure retirement income for Canadians. FDI brings other benefits since it bundles financing and know-how. Being open to capital flows may also have collateral benefits. It can catalyze competition, promoting the development of the domestic financial system and provide a force for better governance. While these potential benefits of capital mobility are real, they are hard to pin down empirically. That is partly because they materialize over a longer time period. At the same time, the challenges associated with financial openness are only too easy to identify. Take the examples of Mexico and Thailand in the 1990s and of Greece in the mid-2000s. The experiences of those countries taught that financial flows from abroad can fuel growing macroeconomic and financial imbalances that later unwind in a destructive way. A capital inflow surge, under certain circumstances, can encourage unsustainable spending by domestic households, companies, and government. This unsustainable spending is mirrored in a current account deficit. A sudden stop in those inflows, particularly if accompanied by capital flight, where a country's own residents move their assets abroad, can result in a crisis that forces an abrupt contraction of domestic spending. Inflows of capital are often associated with a buildup of financial system vulnerabilities, which can have important consequences for financial stability. This is particularly the case where a domestic financial system is lacking the ability to efficiently and safely intermediate large gross flows. To the extent that there are weaknesses in a country's financial system, opening the capital account can feed those weaknesses and result in a larger buildup of imbalances. These can include currency, maturity, and liquidity mismatches. Of course, in some cases where liquid, short-term, foreign currency-denominated banking flows are used to finance longer-term domestic currency lending, you get all three of those vulnerabilities. Waves of foreign capital can also fuel credit booms, which are associated with mounting leverage and deteriorating credit quality. When the flows reverse, these vulnerabilities can amplify the effects on the domestic economy, in some cases triggering a wave of bankruptcies. In theory, exchange rate flexibility should mitigate the risks associated with large net capital inflows. This was the basis of Robert Mundell's famous trilemma. A country cannot have an open capital account, a fixed exchange rate, and an independent monetary policy, but with a flexible exchange rate, it can use monetary policy to stabilize its economy, even in the presence of international capital flows. Consider the case of a country experiencing capital inflows. Its currency would tend to rise in value, which, other things being equal, would have a negative effect on its net exports and on economic activity more generally. But the country's central bank, tasked with stabilizing the economy, would typically respond with a lower policy interest rate. The combination of a stronger currency and lower domestic interest rates would make foreign investments in the country less attractive, thus attenuating the capital inflows. However, it doesn't always work this way. Many countries do not allow their currencies to adjust fully. Indeed, credit booms typically occur in countries with fixed and managed exchange rate regimes. It is also possible that even with a floating exchange rate, appreciations can perversely encourage further capital inflows, exacerbating the problem. This could occur through the risk-taking channel. If domestic borrowers have local currency assets and foreign currency liabilities, an appreciation in their currency could increase the value of their domestic assets and therefore actually make their balance sheet look stronger. This increase in perceived creditworthiness, even while vulnerabilities are building up, could lead to the provision of more foreign currency lending as capital inflows through the banking system increase. In a similar vein, it has been argued that even with a floating exchange rate, a country's financial conditions depend primarily on a global financial cycle, limiting a central bank's ability to use monetary policy independently to influence its economy. One scholar thus argued, that's Ellen Ray, that Mundell's trilemma boils down to a dilemma. Independent monetary policy, as she puts it, are possible if and only if the capital account is managed directly or indirectly via macroprudential policies. Now, the most familiar example of this pattern where international capital flows enable domestic economic and financial imbalances to build up come from emerging market economies. But this is not just a developing country issue. Think, for example, of the United States prior to 2008. The distorted incentives and regulatory weaknesses in the US financial system during that period are well known. In that context, the ability to borrow cheaply at global interest rates that reflected high savings rates in China and other EMEs contributed to the growing financial bubble. This pattern and the ensuing crash, which took place in the world's most sophisticated financial system, had many elements that are familiar from EMEs in the past. To sum up, while there are known benefits of financial openness, a country can only reap those benefits if it also avoids some important pitfalls. If a country has major distortions in its financial system, perhaps reflecting weaknesses in regulation, opening the economy to capital flows may just feed those distortions. To turn this around, a country may need to achieve a certain level of financial system soundness and standard of governance before it can fully reap the benefits of capital mobility. Based on this logic, a number of researchers have suggested that there is a threshold. Capital flows are beneficial only once a country has reached a certain degree of institutional and financial sector development. Where those conditions are lacking, say, when financial regulation is inadequate or property rights are inadequately protected, financial openness can invite instability and, on the whole, can be detrimental to economic growth. Above that threshold, capital flows can provide broader benefits which can support rising living standards. The threshold argument suggests that countries may choose two distinct strategies. One, is to try to manage or control capital inflows, or at least to cushion the economy and the financial system from their impact. The other approach is to try to achieve the threshold. Of course, these strategies can be complementary if a country uses capital flow management effectively to buy time to strengthen its domestic system. The international view of capital controls has shifted over time. Most advanced economies maintained pervasive restrictions on capital movements during the period following the Second World War, but opened their borders to capital flows during the 1960s through the early 1990s. Liberalization was generally seen as irreversible. As one observer during that period said, "You can't put the toothpaste back in the tube." While many developing countries maintained capital controls, the Washington Consensus saw liberalization as clearly the right destination, albeit with important issues concerning the pace and the sequencing. In contrast, and based on extensive international experience, capital control measures were viewed as distortionary and ineffective. The role of capital controls is being reassessed in light of the experience of both the financial crisis and the subsequent capital flow surges associated with the monetary policies of the major advanced economies. Capital controls are often viewed as a form of macroprudential tool to limit the resulting buildup of vulnerabilities. Used in combination with other macroprudential tools, they could give monetary policy a freer hand in maintaining domestic macroeconomic and price stability as well as financial stability. This reassessment is reflected in recent reformulation of policy on capital flows by various international bodies, including the G20 and the IMF. For example, G20 finance ministers and central bank governors have concluded that capital flow controls could be appropriate, provided they were temporary, targeted, and transparent. However, capital controls, like tariffs on trade, have spillovers to other countries, and that suggests a need for governance similar to that for trade restrictions. The G20 has established a working group on international financial architecture that is focusing on managing the risks stemming from capital flow volatility. This group has highlighted, among other things, a need for better data on the composition of flows to better identify the currency and maturity mismatches that may be building up. A broader goal is to complete the global financial safety net, the set of financing arrangements available to countries faced with unexpected reversals of capital flows. The emerging global consensus is that capital controls can appropriately be used under some circumstances, particularly to mitigate the buildup of financial vulnerabilities. But they should not be used to compensate for inconsistent or inappropriate macroeconomic policies. Their effectiveness varies and typically diminishes over time. Finally, if controls are used to shore up an unsustainable exchange rate peg, they may exacerbate rather than stem volatility. This is the classic one-way bet scenario. The strategy creates the expectation that the exchange rate will eventually adjust, thereby actually inducing additional speculative capital flows. To summarize the argument so far, capital controls are available as a tool to cope with volatile capital flows, but they are, at most, a second-best tool. Over the past 20 years or so, many EMEs have adopted a different approach. They've taken action to prepare their financial systems and economies to cope with the free movement of capital. They have put their fiscal deficits onto sustainable tracks, established credible frameworks for monetary and fiscal policies, developed deeper and more liquid domestic financial markets and stronger financial systems, and tackled structural issues that impede growth. All of these actions reduce their vulnerability to capital flows. Canada's experience has in some respects been similar. Around the time of the Mexican peso crisis in the 1990s, some observers referred to our dollar as the northern peso. Our exchange rate and borrowing costs were buffeted by changing market perceptions of the financial strength of our government and of our banks. That was a wake-up call which led us to put our house in order. Canadian policymakers strengthened the regulation of our financial system, taking the prudent, principles-based approach that today underpins the soundness of the system. The federal government cut the deficit and now has fiscal room to maneuver. and the Bank of Canada adopted a clear target for monetary policy and built credibility around that target. These actions have not completely insulated the Canadian economy from the global financial cycle, of course. Canada's market-determined interest rates are, indeed, heavily influenced by global term premiums. But despite that influence, the Bank of Canada retains the ability to affect market interest rates and other aspects of financial conditions in Canada. One key element here is what's happened to the country risk premium. In many emerging market economies, the currencies and asset valuations contain risk premiums that reflect their creditworthiness compared with that of the United States. These risk premiums can be time-varying and tend to be correlated with the global financial cycle. They tend to rise during risk-off periods and fall during risk-on periods. Canada's credit risk premium, through the actions that I mentioned, has been reduced to a very low level as a result of strong economic and financial fundamentals. As a result, our asset prices and interest rates are less affected by the global financial cycle. Many of Canada's large gross flows of capital also tend to be offset by other flows, contributing to our overall resilience. Now, this also squares with IMF research, which has shown that such offsetting flows are characteristic of countries with sound policies, well-regulated institutions, flexible exchange rates, and open capital accounts. In contrast, capital controls may reduce resilience in some ways by impeding such offsetting flows to take place. Another factor that works in Canada's favour is that, unlike many EMEs, it's able to borrow in its own currency. That means that our national balance sheet does not have an excessive currency mismatch. Where such mismatches are important, exchange rate depreciations can be contractionary because the balance sheet effects of a weaker currency inflate the size of national liabilities, and thus overwhelming the expenditure switching effects that occur through the trade channel. In contrast, when the Canadian dollar depreciates, that tends to support the Canadian economy. For example, the substantial depreciation of the Canadian dollar during the past few years has helped to cushion the Canadian economy by making our non-commodity exports more competitive. Being able to borrow in one's currency, in turn, is a benefit of having a strong track record of sound macroeconomic and financial policies. The credibility of Canada's monetary policy framework, together with our floating exchange rate, also give us more room to respond to shocks that are likely to have a differential impact on the Canadian economy than on the US. And one major example is last year, the Bank of Canada cut the policy interest rate twice to help cushion the Canadian economy from the effects of the collapse of oil prices. When we did that, we were confident that inflation expectations would still remain well anchored, despite the depreciation of the Canadian dollar that was occurring. The global financial cycle and policy actions by the Federal Reserve can have important implications for Canada. These are, of course, factored into the Bank of Canada's monetary policy decisions. As a concrete but still hypothetical example, suppose the Federal Reserve were to make an upward adjustment to its policy rate. Such a tightening in US monetary policy would affect Canada through two main financial channels. It leads to higher market interest rates globally and thus in Canada, in a sense, a tightening for Canada. And it also leads to a stronger US dollar, which increases the competitiveness of our exports, which is in effect a stimulus for Canada. It's also important to note the economic setting for such an interest rate move, and that's something a very important thing to take into account. The Fed's rate move would likely be made in response to a strengthening US economy, which is itself typically favorable for Canada. Il est donc clair que la Banque du Canada devrait prendre en considération, entre autres, les incidences nettes de la politique de la Réserve fédérale lors de l'établissement de sa politique monétaire. La Banque est libre d'ajuster son taux directeur en fonction de la situation économique de notre pays. En particulier, elle n'est pas tenue d'être en phase avec la Réserve fédérale. Et ce taux directeur se transmet efficacement pour stabiliser l'économie canadienne. The Bank of Canada would thus clearly need to take the net effects of the Fed's move into account alongside many other factors in making Canadian monetary policy. We could directly observe the effects on interest rates and exchange rates prior to making a policy decision. We wouldn't have to guess what those effects might turn out to be. And certainly, we would not consider the implication of such a move by the Fed in any mechanical way. The Bank of Canada's track record, delivering low, stable, and predictable inflation for the past 25 years in the face of many shocks affecting our economy, attests to Canada's ability to pursue an effective monetary policy in a world of globalized capital flows. We are free to adjust our policy interest rate in light of Canadian economic conditions, and in particular, we do not need to move in step with the Federal Reserve. And that policy rate is transmitted effectively to stabilize the Canadian economy. Let me conclude. I began these remarks by noting that Canadians have learned to live with an open capital account. That goes for policymakers too. While global interconnections are a major factor in gauging the effects of our policies, they do not circumscribe our ability to set our own course. But the variety of international experience at our own past reminds us that our resilience has been hard-won. Even now, not all countries are ready to benefit from financial globalization. We should be supportive of other countries as they take actions as they deem appropriate to safeguard their own economic and financial stability. A stable world is something from which we can all benefit.
Well, thanks very much, Tim, for a very interesting presentation. Now we only have a short time, about 15 minutes for questions, and if you could, when you do ask a question, if you could please identify yourself. But while the audience debates whether to ask a question, we have a question that was supplied independently, and in view of the events of the past week, you probably won't be surprised at this one, but in what way do you expect the Trump presidency to most forcefully affect Canada's economic outlook?
Yes, that is a predictable question in the current climate, and it's not a question on which I can really say very much at this point, and it's certainly not appropriate for me, speaking from the Bank of Canada, to comment on the U.S. political scene at this point. Certainly U.S. policies more generally do affect Canada through a number of channels, and I've referred to some of them. And of course, once policies are announced, particularly with regard to fiscal policy and international trade, then these are things we would factor into our economic outlook and forecasting. But at this point, I think it's really too early to gauge what those effects will be and what effect they might also have on business confidence. So with that, I'd have to say that we'll be watching this very closely in the period ahead.
Thank you. So we'll start with, okay.
Hello, my name is Richard Pereira. I'm with the Global Ethics Program at the University of Birmingham in England. And what I'd like to hear a little bit more about is what percentage something like offshore tax havens comprise of in international capital flows. And we've heard quite a bit about it with the release of the Panama Papers and a lot of exposure in recent years. So if you could say something about that and whether or not you have an opinion on whether these tax havens should be prohibited.
Well, of course, that's not directly related to the topic of the speech, but it certainly has been a topic that's been very high on the agenda of the G20 for the last couple of years, particular. And there's an extensive initiative going on to try to improve the sharing of information and to ensure that the sources of financing and the beneficial ownership of various assets are identified more clearly, so that incomes can be taxed more effectively in the jurisdictions where they're actually earned. Of course, it's particularly challenging in the current information-based economy, where you've got so much income comes as revenues to intellectual property. But this is clearly an issue on which international policymakers are very much focused, not directly in the sphere of central bank policy, but certainly more broadly something that the G20 is quite, I think, determined to make progress on.
Thank you.
Hi, Samantha St. Amon with CG. Thank you so much for coming to Waterloo to talk today, Tim. You discussed a new emerging consensus about capital flow control measurements since the global financial crisis. There have also been sort of an emerging view about how better cooperation or coordination of macroeconomic or monetary policy might help reinforce the benefits and reduce the cost from capital flows. And I'm wondering what your views are on improving cooperation of macroeconomic policies or monetary policies are for reducing the cost of capital flows. And I'm also wondering what view the Bank of Canada brings to the numerous events it attends around the world every year at the IMF, the G20, the BIS, and numerous other events where central bankers come together and cooperate. What view does the Bank of Canada bring to those?
Yeah, that's a very good question. And certainly this whole issue of international cooperation is really, I think, particularly important in the wake of the crisis. I mean, all central banks around the world are facing a very new environment. I think a lot of the sort of interrelations among different among different economies and different parts of various economies have been shifting over the last few years, and some of that's really a reflective fallout for the crisis, but some of it's also a reflection of longer-term trends that are going on, demography and technology, for example, that are shifting growth rates and that sort of thing. So in that context, I think it's obviously, I mean, one of the key elements is for policymakers to communicate more effectively among themselves, and we have a number of fora where that takes place. In the BIS, central bankers get together and compare notes on what's happening in their economies and what they're likely to, how they view various developments that affect them, and also, of course, in the G20 and the G7, there are a number of those discussions that take place. Now, obviously, the issue of coordination of the policies themselves is one where I think the circumstances have changed over time, and certainly in the immediate wake of the crisis, we saw a very coordinated effort by central banks and finance ministries of a number of countries to do what it took to avoid a second Great Depression. I mean, basically, we had a massive fiscal stimulus in many of the major economies. We had a very rapid easing of monetary policy. We had a whole panoply of measures to keep the financial system functioning, and all of those measures were directed towards keeping a bad situation from becoming vastly worse than it was. But of course, the last 7 years, of course, have been a very different kind of period where it's been more of a long road home rather than this sort of immediate sense of crisis. And in that context, of course, we've got a lot of discussion among the policymakers, a lot of sharing of information and views. But at the same time, policies, I think, are largely being directed towards domestic objectives. And each central bank, for example, has a domestic mandate. We have a mandate for inflation in Canada. And that's our, we have a responsibility to meet that mandate, and similarly for other central banks. And so the idea that central banks might do something differently than they would otherwise do in order to reduce the spillovers in other economies is something that is probably less likely to occur in that current setting.
Thank you.
My name is Madhu Kalamipalli with Wilfrid Laurier University Business School, where I'm a professor in finance. My question is to do with how the nature of capital flows are sort of moving away from sovereign debt towards corporate debt. Case in point is the negative yield debt. 8 countries perhaps have about $13 billion, $13 trillion $13 billion of negative yield debt that has been issued. My point is, these countries are using negative yields as a way to jumpstart their economies, but by doing so, I think the capital flows are now chasing not sovereign debt but corporate debt. Not long ago, even Bank of Canada governor hinted that Canada could have negative yields. So my question to you simply is, the change in the composition of the capital flows going from sovereign to corporate, and maybe it's a great time for corporations to go and issue debt these times to attract international capital flows. Thank you.
Yeah, I mean, I think that is an interesting an important set of issues, and I think really what it speaks to is the search for yield that's been generated by very low interest rates and by unconventional monetary policies in most of the advanced economies. And of course, that search for yield implies that all kinds of investors are moving to look for investments that offer risk premiums, that offer liquidity premiums, that offer other sources of return beyond just the value of time, which is the risk-free interest rate. And so in that context, of course, this is a good time for borrowers in various types, but it's one where I mean, risks do build up in the system, and of course we've seen that in a number of forms in different countries. And to some extent, it is exactly the effect through which monetary policy works. You lower policy interest rates, and investors are prepared to take more risks. They're prepared to buy corporate debt, and then that means the corporations are in a position to finance various types of spending on new machinery, equipment, factories, and so on. And that channel should ultimately be what gets the economy back to its full potential. But of course, in the process of doing that, it does build up some other vulnerabilities. I mean, at this point, given that that's the tool that's available to central banks to stimulate the economy, I mean, to counteract the negative forces that are working on their country's economies, then it's a tool that has to be used. But at the same time, those side effects really do have to be watched, and often with a view to ensuring the prudential standards are high enough that the institutions taking the risks are actually in a position to assess and manage them properly.
Thank you. We have time for one more short question, please.
My name is Mike Gentile. I'm a certified financial planner and chartered financial consultant. I have a business practice in the area here. And first of all, I'd like to say thank you very much, Dr. Lane, for coming here to share with us your knowledge. My question is kind of similar to a question that I asked a former governor of the Bank of Canada many, many years ago. It related to interest rates. So my question now is kind of along the lines of how good is your crystal ball as it relates to petrodollars, inflation, and interest rate range over the next 10 to 20 years? Keeping in mind that we live in a global village today, you must have some models in place to address some of those issues down the road. Can you share with us your information or knowledge around that?
Okay, well, how good is our crystal ball? I think it's as good as it can be under the circumstances. I mean, but I think it's fair to say that this has been an incredibly challenging environment, and I mentioned this earlier. I think for any kind of economic projections, and I think partly, there are some effects that are pretty predictable. I think the demographics are what they are. I mean, we've got baby boom generations that are retiring. That is having some very predictable effects on growth rates in many countries. We see growth slowing in countries like the U.S. and Canada. That implies slowing growth in demand for a lot of products, for raw materials, and so on. We've got lower long-term interest rates in many countries. I think on a long-term basis, because and again, just because with a lower growth rate, there are fewer opportunities for investment relative to the savings in the economy, and that tends to imply a lower level of interest rates prevailing in the economy, even once the economy's kind of got back to normal or got through the current cycle. And so those things are things that I think we're relatively confident about. I think there are other things that might be driven by technology and by economic policies, which are a lot harder to fathom. And that's something that I think we're in some ways fortunate that when we make monetary policy, we publish forecasts for the next 2 years and not for the next 20, because a lot of these other trends are probably ones that the existing models don't give us as much guidance about.
It's interesting to note that other central banks these days are recommending or influencing banks in Europe to go with negative interest rates. Of course, we know that the raison d'etre around that is to encourage people not to deposit money, but to invest it back in the economy and create employment. What are your thoughts around that?
Well, I mean, it's a tool that could be used, and we've spelled out. I mean, our governor gave a speech a year or so ago, as somebody mentioned. But it's one that we don't expect to use, and we hope not to, because it's something that we would only do if other means of expanding monetary policy by through conventional positive interest rates actually ran out of room, and so it would really be something that we could only bring into play if the economy weakens significantly.
Thank you very much. I don't know if Tim remembers, but the last time, at least I saw you here in Waterloo, was at a conference which I organized along with CG when the building was brand new. You were in a different part of the building.
That was in the distillery.
That's right, yes, yeah. That's right. And so we're very happy to have you back. We thank you very much for coming. We've heard a lot about the global financial cycle, which is something that's well, we've known about for some time, although we didn't use that terminology, so it's a fairly recent in the lexicon that economists use. But alongside with that, we see a return to some favor for capital controls, which in Canada is something that's quite foreign to us. And in fact, I was trying to think, but the last time in Canada this was somewhat of a controversy was back in the 1950s, as we were adopting floating exchange rates while everyone else was pegging their exchange rate. So things do come back, and we also learned again that the mirror image of the capital account is the current account, so we can't exactly ignore one at the expense of the other. And also about the role of flexible exchange rates, that while it's proven very useful for Canada, I think we have the world's record for how many years the exchange rate has floated. But it's not a perfect system, that we do have to be on guard for the financial implications of even under a floating exchange rate. So once again, on behalf of CG, I want to thank you again for taking the time to come to Waterloo and for a very interesting talk. Thank you.
Thanks, it's my pleasure.